everyone, welcome back to Outside the Dollar. I'm Elena, and I'm glad you're here. Today, we're talking about what it really means when a country owes about as much as it produces in a year. You see headlines about the debt to GDP ratio all the time, but what does that actually look like in a portfolio and in day-to-day life for regular Americans? Is this just a big abstract number, or does it change your mortgage rate, your job prospects, even your retirement plans? We'll explore how a high debt load can shape inflation, how it can limit or expand government spending choices, and what rising interest costs might signal for the next decade. And we've got a special conversation lined up with John, the CEO of Lear Capital, digging into that big question: what happens when the country owes as much as it makes? Think of this episode as putting on an advisor hat for the entire economy and stress testing some of the usual narratives around debt and inflation. As you listen, you might want to ask yourself, where does my own balance sheet rhyme with what's happening at the national level? All right, let's start with a quick check-in and some housekeeping, then we'll move straight into how the debt to GDP ratio actually touches your life. Hi, John. It's great to have you here. I've been looking forward to getting into when the country owes as much as it makes with you. How are you doing today?
Hi, Elena. I'm well, thank you. And how are you?
I'm doing really well. Thank you for asking. I appreciate that. When people hear that U.S. debt has reached 100% of GDP, what does that actually mean in plain English? And why should it matter to everyday Americans?
Debt to GDP compares what the government owes to the size of the economy. When debt is near or above 100% of GDP, it means the debt burden is roughly equal to 1 year of total U.S. economic output. In plain English, it's like saying the country owes about as much as the entire economy it produces in a year. That matters because the larger the debt becomes, the more difficult it can be for the government to manage its obligations without creating pressure somewhere else. And finally, on this point, these pressures can show up through higher taxes, reduced spending flexibility, more borrowing, more money printing, which leads to inflation or pressure on the dollar.
That's a really clear breakdown. You mentioned money printing and inflation. When you look at the current environment, how much of what we're seeing in terms of inflation and dollar pressure is directly tied to that debt dynamic versus other factors?
A significant factor, make no mistake, as the government spends more, be it for fixed needs like Social Security, Medicare, and Medicaid, you have less wiggle room, less room to pivot. And as inflation creeps up, interest rates potentially going up, that creates a greater cost to service the debt. It's a big problem.
That cycle you're describing, less flexibility, rising interest costs, it sounds like it compounds pretty quickly. We saw similar debt levels after World War II, but some economists argue today's situation is fundamentally different. What's your take on that?
I agree. The post-World War II debt spike came after a major emergency. Today's debt is being driven by long-term structural spending and ongoing deficits that can make it harder to grow out of the problem. After World War II, the debt spike was connected to a specific emergency, financing the war. The dollar became the world's currency before the war ended, and its global dominance was fully recognized in the post-war period. Once the war ended, emergency spending declined and the country entered a period of strong post-war growth. The U.S. also had a younger population, an expanding workforce, and a manufacturing boom that helped the economy grow. Today's debt picture is different because it is tied to more ongoing structural deficits. The government is spending more than it takes in year after year, even outside of a declared emergency. I gave some examples earlier based on the long-term obligations of Social Security, Medicare, Medicaid, and the interest on the debt. That makes it harder to grow out of the debt problem.
You've laid out a really important distinction there, the structural versus the temporary. Given those ongoing deficits and the pressure on the dollar you mentioned, we're hearing a lot about what some call the de-dollarization trade, where major investors are reducing their exposure to dollar assets. How does high debt and rising interest costs actually affect confidence in the U.S. dollar?
The dollar remains our world's dominant reserve currency, but Confidence depends on trust. When debt rises, deficits remain large and interest costs consume more of the federal budget. Investors may begin reassessing how much exposure they want to dollar-based assets. Recent reports suggest some large family offices are already thinking this way, not necessarily abandoning the dollar, but diversifying more broadly because of concerns around debt, policy uncertainty, and long-term purchasing power. Confidence in a currency depends on trust in fiscal management, political stability, monetary discipline, and long-term purchasing power. Reuters reported that a UBS survey found wealthy families reducing exposure to the US dollar amid geopolitical risks and rising US debt. The report also, roughly 2/3 of respondents expect confidence in the dollar as a global reserve currency to decline over the coming year. For everyday Americans, the concern is purchasing power. If the dollar weakens over time, the same paycheck or savings account may not stretch the spot.
That purchasing power angle is crucial for people to understand.
In an environment where there's concern about debt, inflation, and the long-term value of the dollar, why does gold often come into the conversation as a potential hedge?
Gold is a tangible asset. Historically, it's a store of value and something people may consider as part of a broader diversification strategy with their portfolio. Gold has been treated this way for thousands of years. Unlike paper currency, gold cannot be printed by a central bank. Gold does not pay interest or dividends, but many investors look at it as a diversification tool as it can behave differently from stocks, bonds, or cash. And central banks also hold gold as part of their reserves and have been buying at record levels for the past 5 years, which reinforces the idea that gold plays a role outside the traditional paper currency system. The World Gold Council has described gold as a highly liquid, scarce asset that is no one's liability and carries very little risk. Deutsche Bank predicts gold could hit $8,000 per ounce by 2031. Historically, gold has preserved purchasing power over the long term.
That's compelling context. Central banks buying at record levels really does signal something about how they're thinking about reserves. What about silver, though? Why might silver also be worth looking at in this kind of environment?
Gold is a tangible asset. Historically, it's a store of value and something people may consider as part of a broader diversification strategy with their portfolio. Gold has been treated this way for thousands of years. Unlike paper currency, gold cannot be printed by a central bank. Gold does not pay interest or dividends, but many investors look at it as a diversification tool as it can behave differently from stocks, bonds, or cash. And central banks also hold gold as part of their reserves and have been buying at record levels for the past 5 years, which reinforces the idea that gold plays a role outside the traditional paper currency system. The World Gold Council has described gold as a highly liquid, scarce asset that is no one's liability and carries very little risk. Deutsche Bank predicts gold could hit $8,000 per ounce by 2031. Historically, gold has preserved purchasing power over the long term.
That structural shift in demand, industrial use now dominating, that's a really different picture from just thinking of silver as a monetary hedge. Given everything you've laid out about debt, dollar confidence, and these resource dynamics, how are you thinking about what investors should actually be doing right now?
Silver plays a dual role, monetary metal plus industrial demand. Like gold, silver has a long history as a monetary metal, but silver also has significant industrial demand. In late 25, the U.S. officially designated silver as a critical mineral, recognizing how essential it is to technology, energy, and national security. This isn't a U.S. story. Governments around the world are increasingly treating strategic metals like silver as national assets. We're seeing a broader trend of countries tightening control over natural resources that are vital to industries and national security, such as China recently setting limits on silver exporting. We've been running a silver deficit ongoing for 6 years now. Silver is mostly mined as a byproduct of other metals, so you can't just flip a switch and produce more silver when demand spikes. Important to note, industrial demand now represents nearly 60% with global silver demand, structural shift from the past. And finally, Bank of America has predicted that silver could reach $135 to over $300 an ounce by year's end.
That's practical guidance. When you're working with investors at Lear Capital, what's the most common concern or question you're hearing from them right now about their exposure and timing?
I want to be working with someone they're confident in, firm like Lear that has over 30 years of experience in precious metals. It's done over $3 billion in transactions, and we're very focused on educating, informing the prospective customers so they can learn and be confident in decision making coming forth on a purchase.
That trust and education piece really matters, especially when people are making decisions about their portfolio in uncertain times. You've built that over 3 decades. What's changed the most about how investors are approaching precious metals now compared to earlier in your career?
Years ago, I think there was less understanding, less certainty. I believe over the last handful of years, gold in particular, but silver also more recently, have been front and center in the world of finance and investment and wealth management. So consumers are beginning to better understand the benefit and value of having diversification in terms of asset within their portfolio.
That shift in awareness is significant. As you look ahead at the trajectory of debt, deficits, and what's happening globally with currencies and resources, what's your outlook for the next few years? And how do you think that shapes what investors should be thinking about?
I think it's an opportune time to purchase gold and or silver. We have a very compelling story around their place in the history of investing. We've got a lot of consternation, uncertainty around the globe with tensions in the Middle East, tensions between the U.S. and China and elsewhere. And so as we see the shift, and we talked about this a moment ago, and some de-dollarization of wealthy families, family offices pivoting and having less exposure to U.S. assets like securities, treasury securities, people are now pivoting over to more of gold and silver.
You've painted a pretty clear picture of why people are thinking about this now. Before we wrap up, is there anything else you'd like to share with our listeners about navigating this environment or what they should be considering?
I strongly recommend that our listeners go to Lear, L-E-A-R, to learcapital.com to get more information and learn about our history and what we offer, whether it's going to be gold and silver, if they're going to purchase for personal possession, or if they're going to purchase gold and silver for their self-directed IRA. Go to learcapital.com to learn more.
John, this has been such a great conversation. Thank you so much for coming on and breaking down something that can feel really abstract, the debt, the dollar, the geopolitical shifts, into something people can actually understand and act on. I really appreciate your time today.
Thank you, Elena. Appreciate your time too.
You're very welcome, John. Take care.
That was such a great conversation with John. I'm still chewing on this idea of the U.S. owing basically as much as it makes. When people hear debt at 100% of GDP, it sounds abstract, but I loved how John framed it. It's like your household owing your entire annual salary. You can function, but you've lost a lot of flexibility. And then layering on de-dollarization, for years we've taken it for granted that the dollar is the world's reserve currency. Hearing John walk through how persistent deficits and political dysfunction chip away at that status was a little sobering. What really hit me was his comparison to the post-World War II period. Yes, debt was huge back then, but we had explosive growth, a young population, and rising productivity. Today, we've got slower growth, aging demographics, and much higher long-term promises baked into the system. It's just not the same playbook. Interestingly, I didn't expect the silver angle to be so compelling. Gold gets all the headlines, but his point about silver having that dual role, monetary hedge and industrial metal tied to things like solar and tech, really stood out as a sort of two-for-one way to think about uncertainty. Tying all of this back to inflation and money printing, John's reminder was key. You might reduce the real value of the debt, but you're also quietly taxing savers and workers through higher prices. Lots to digest there. Stick around. We'll wrap this up in the outro and share how you can dig deeper into John's full interview next. So, as we wrap, remember the big idea from our debt to GDP conversation. Your financial life reacts to these macro shifts through purchasing power and interest rates, not just scary headlines. The important thing to understand is that gold, silver, and cash are tools. You're not betting on the end of the dollar, you're shaping how resilient your portfolio is. If you want Lear Capital's latest research on gold and silver, visit learcapital.com or call 800-576-9355 to talk with a specialist. And if this episode helped you think differently, follow the show, leave a quick review, and share it with a friend who's wrestling with these questions. Thanks for spending this time with me on Outside the Dollar. Now, let's go make smarter decisions with it.